Welcome back to the portfolio update video. Today I will be discussing how the Russia and Ukraine situation is affecting your portfolio and discussing how my portfolio is tracking along, as I am sure everyone looks the same, and that is red. Stocks have been on a horrible tear. I mean, just looking at my portfolio, I'm down 2.19% just today, and my overall portfolio is now down 7.99%. After being up over 10% not too long ago. I mean, look at VOO. The overall market is down nearly 12% year to date. Everything is going bad. The QQQ is down 18% year to date. This just shows the negative effect that tech stocks are having on the market, with all the growth stocks being hammered. You have Netflix, PayPal, all of these stocks, great companies, Spotify, all being smacked down as growth stocks fall. As I go through my portfolio, Apple is one of the rare stocks that I'm actually up on. It's had a horrible week, down 6%, but it's still the same over the month, and it's not a stock that I'm worried about. Alibaba is one that I've been hammered on. The stock is down to $109 a share. I'm down 33% on the stock, which is way less than certain investors. My average price is $165, and I think it will be a long time before we see those results again. Costco is another stock I'm down on, but it's only a recent purchase, so I'm not too worried, and it is another great company I believe in. Facebook is down heavily. It's down to $198. I'm down 40% on the stock. Overall, this was a company I believed in, and still do, but this negative news and this growth smack has hit it like nothing. It's all the way down 40%. My average share price is $335. Just going down through my portfolio, all these tech stocks are down. JP Morgan's down, the QQQ's down, and the market's down. So VOO and SPY are both down. Overall, I'm not even going to change my investment strategy. I understand that there's ups and downs in the market, and there'll always be something talked about. Before it was COVID that was bringing the market down, and now it's this possible war. There will always be something bringing the market down as it goes through its ups and downs. I will continue to invest, and hopefully, investing now and buying cheap will help me in the long run to get better percentages. This article by Bloomberg has just been put out recently, labeled "What the Ukraine-Russia Tension Means for Stock and Investors' Portfolios." This was made by Charlie Wells, and on the 23rd of February. They say tensions in Ukraine have markets on edge, stocks are swinging, oil is closing on $100 a barrel, and uncertainty looms over investors, big and small. But it's more of a short-term headache than a long-term drag. That's the view analysts on both sides of the Atlantic trying to discern what the geopolitical crisis means for investors' portfolios in the wake of Russia's recognizing two self-proclaimed republics in the eastern Ukraine. Tom Essay, a former Merrill Lynch trader who founded the 7 Report newsletter, sees the conflict dominating near-term headlines, but he doesn't expect it to dictate market moves in the long or even medium term. Instead, the most important factor remain the Fed tightening and economic growth, he wrote. JP Morgan strategists were of similar mind in recent note to clients, citing the larger risk of tightening monetary policies for equities and noting that the Russia-Ukraine tensions are a low-earning risk for US corporations. But an energy price shock amidst the aggressive central bank pivot focused on inflation could further dampen investors' sentiment and growth outlook, they wrote. In the UK, Bloomberg Intelligence equities strategist Tim Craighead wrote that the European stocks face limited risk unless Russian energy supplies are cut. The crisis might shuffle the leaderboard temporarily in terms of European equities. Craighead noted that the market seemed to be focused on rising inflation, elevated margins, and central bank tightening. Still, Steve Clayton, who managed HL selected funds at Hargreaves Lansdown in the UK, noted that the crisis won't be over in a blip. Russian troops have not massed along the Ukraine border in order to hold the cake sales, he wrote on a Tuesday note. However, these unfolds, tensions and uncertainties are likely to run hot for some time to come. The market will not make any escalation, nor will it trust any settlement between the parties unless accompanied by rapid demobilization of Russian forces around Ukraine. Clayton sees US Treasuries and Japanese government bonds as a potential beneficiary as investors seek safe havens. Given the nature of the conflict, defense stocks, such as BAE System plc, as possible destinations, given that European politicians are unlikely to urge for lower defense spendings, while the Russian bear is growing angrily. They also speak about banking stocks and how they have outperformed in Europe so far this year, and they could be losers, as the UK just announced sanctions on 5 Russian banks. Overall, these are tough times, and tension all amongst Europe and amongst the world is affecting stocks and your portfolio. Even mine. No matter how diversified you are, everything is down. Across the market, across all sectors, it is red. So I say, I'm just going to wait this one out and continue my investing and look for the long term. I don't see this having too of a long-term effect on my portfolio, and hopefully this can all pass and get settled, and we can go back to market stability, or what's supposed to be market stability, in our market that just keeps going up and down. Overall, that was a quick look into my portfolio and my thoughts on this ongoing conflict and how it will affect my portfolio and yours. Subscribe for more weekly content and more weekly portfolio updates, and leave your thoughts in the comments and leave a like if you enjoyed.